Good morning, ladies and gentlemen. My name is Martin Stanley, and this is my colleague Scott Gallagher, and welcome to the latest in a series of webinars we're presenting to our clients and people who might be clients about issues to do with financial planning. So today we're looking at strategies for the end of the tax year, which is a timely webinar because we've got sort of a few weeks left now. So, one second for a moment. There we are. So just at the very top, why tax planning matters. You probably know it's because you want to pay less tax, but a few specifics. There are some pitfalls you can face. 60% income tax. Some of you might be thinking, surely it doesn't go that high, but it can. Loss of child benefit can be affected by your earnings. That's a tax issue as well. Capital gains tax is quite high at the moment at 24%. That can affect people with investments that aren't in ISAs. And of course, that dreaded tax that everybody fears, inheritance tax. So today we'll show you some ways that we can minimize these or even avoid them sometimes. So just before we start, at your end, the microphones are muted and your camera's off, so you can just sit back and watch us. And there's a Q&A feature at the bottom of your screen so that you can pop in any questions, which we'll answer at the end. And at the end of this, we will send a copy of this webinar to your email so you can watch it again if you'd like to. This page is just to tell you that anything we say is general information, and for actual advice, you should come to us personally. So that's us. And without further ado, questions we're going to answer for you today. The spring statement was early this week, so did it change anything important? Where are the hidden tax traps in the system? There are a couple of sneaky ones which we'll identify for you. Can pension contributions reduce your tax bill? Spoiler, yes they can. Are you using ISAs as effectively as possible? Most of you will know about ISAs, but there are ways to use them which are more efficient than others. Income splitting is something perhaps you might not know about, but that's something which can really help for married couples and civil partners. What should you do before 5th of April? Not long now, but we've still got a few weeks left. And how can you help your family? So let's dive in. So the Spring Statement 2026. Now, this wasn't a budget, even though it's the Chancellor at the dispatch box talking about economics and the country. The budget is a different time of year, and the Spring Statement is a roundup, more of information to the Parliament and the public. So there were no major new personal tax changes, so don't worry about that. It focused on economic forecast and stability, and you'll have seen in the press and on the news people talking about whether that was good news or bad news. So in many ways, as it says at the bottom of the screen there, no news is good news, but the key thing is that although nothing happened, that nothing is itself impactful because the tax thresholds are frozen still and key allowances are frozen. That means as we hopefully get richer and our wages go up over time, we pay more and more of our money in tax. So that freezing of tax thresholds is actually quite important. But in the Spring Statement itself, earlier this week, nothing that we really need to focus on and worry about. So I told you we talk about some hidden tax traps. Let's just go back and think about income tax first of all. Most of you will know this. You get your personal allowance, which is a bit you get, which is tax-free, and that's 12,570. So if you earn just within that amount, you pay nothing at all. Then there's a basic rate tax allowance, which is where most people sit between 12,500 and 50,000. So an awful lot of people are within that band and they know they pay 20% basic rate tax. The next one up for people who earn a bit more, between 50,000 and 125,000, is a 40% band, so-called higher rate tax. Now, skip to the bottom of the screen, you'll see 125,000 up is the additional rate, 45% tax. But we skipped some section in the middle there, some nasty little tax traps. So between 60 and 80, if you get child benefit, if you're a family, you can actually pay more effective tax because some of that benefit is withdrawn from you. If you're over £100,000, you can also lose tax-free childcare and childcare hours. So that is a form of tax as well, and it takes more money out of your pockets. And also with income tax itself, between 100,000 and 125,000, that personal allowance I mentioned at the top of the screen, that the free bit, the basic personal allowance, that is withdrawn from you if you earn over £100,000. And it's a sliding scale. And that means that you could end up paying 60% tax on a certain band of your income. And the next chart will show us. Here we are. So just to explain the 60% tax band, So I said, if you earn between 100 and 125, just in that band, well, as you earn over £100,000, your personal allowance, the tax-free section, is gradually salami sliced away. It's gradually reduced. You lose £1 of the allowance for every £2 of income you go over the threshold. And what that actually results in the money in that band, you pay 60% tax. And also, as I mentioned on the previous screen, you lose the tax-free childcare, which for a lot of families can be really important. So that's it in a graphic format. So we're used to thinking of the taxes. We all know that you earn more and the tax rates go up and up and up and up gradually. But it doesn't actually look like that. 20, 40, 60, and then 45. So that 60% ban is a real nuisance. It's a real problem. And some people aren't aware of that. We're going to talk about some ways in which we can help. Just an example of how it might affect you in real life. Say you're a £100,000 earner today, which is a good wage, but you get a £1,000 pay rise. Well, you know that you pay 40% in income tax. Yeah, we probably know that already. So that's £400. But then what's this? The loss of the personal allowance, that's the tax-free bit, remember, that means that's on £500. So the tax on that is £200. And that all adds up to £600. So that means on the £1,000 that your boss has granted you as a pay rise, you pay £600 in tax, i.e. a 60% tax rate, not a 40% tax rate at all. You keep just £400. Now, at the bottom of the screen, it says the planning opportunity, which you're going to talk about in a little bit in 5 minutes' time. But it says there's a planning opportunity to make pension contributions or charitable gifts to reduce what's called the adjusted net income, which is a version calculated of your actual income. And that brings you down, for the purposes of the calculation, below the £100,000, which means, yes, you have put money into the pension instead of in your pocket, but you don't pay that 60%, which is a real benefit. Now, the second tax trap, I mentioned people with families who have children. Child benefit is actually a pretty important benefit. That could be quite a lot of money in the pocket each year. But it was decided a few years ago that for higher earners, the government decided they didn't need it as much. So when adjusted net income, and again, that's income once you've taken into account any pension contributions and charitable donations, once your net income there exceeds £60,000, you start to lose it. And on the chart there, you can see up to £60,000, it's green, you get it in full, and over 60,000, it's gradually withdrawn until if you're at £80,000, you don't get it at all. Now, this is a bit nasty because this applies to either people, either parent. So if both parents are earning £50,000, then the household income is £100,000, but this
50,000 each, yeah.
50,000 each, yes.
Yeah.
They still don't lose the allowance because they're under that 60,000. But if any one of them is earning up to 80,000, over 60,000, even if the other person doesn't work at all, they still lose the benefit, which is for those people where one person is earning a bit with the main breadwinner and another person is earning a lot less, that can hit, even though their total income they might not feel is that high. So the effective tax rates there, not quite as bad as 60% we were looking at in the previous example, but between 47 and 56%, that's the effect on your money of earning over that rate and losing the child benefit. Again, at the bottom is this point that if you can reduce what we call the adjusted net income, i.e. bring it down by making a pension contribution or a charitable donation, then that can take you out of that band and save you some tax. So that's something to think about. Here's a worked example. So there's a person who is earning over £60,000 here, they're earning £70,000. Got 2 children, child benefit of £2,200 a year. So they're in that bracket, the 60 to 80 grand bracket. So they're halfway between the two, so they lose half of their child allowance in this case. So they would lose, what, 1,100 of that. But in the planning opportunity at the bottom, this person has put £10,000 of their earnings into a pension. So their adjusted net income is only 60,000. So that means they've restored £1,100 in child benefit, which is great. That goes into their pockets. And also, by making a pension contribution, of course, there's tax relief on the contribution itself, which is something we're going to talk about in a little while. And that also saves £4,000 income tax. So this is a really great way of putting more money in your pocket and less money in the pocket of the Chancellor. So I'm just going to go now into a bit more detail about how we avoid these traps, what the practical steps are you can take. I'm going to take the first couple of sections, and my colleague Scott is going to talk about ISAs, capital gains tax planning, and charitable giving. So let's just go into pension contributions, because I've mentioned that a couple of times already. So is it the most powerful tax planning tool? Well, I think it probably is. So just to recap on how it works, if you earn money and pay tax, well, if you put that money into a pension, you get the tax back. That's basically how it works. And so if you're a higher rate taxpayer, you've paid 40%. Well, it actually only costs you to get a £10,000 investment, £6,000, because 40% is given back by the government. Now, turning £6,000 into a £10,000 investment, albeit in a pension, it is tied up for a bit. That's a pretty powerful tool, I think we can all agree. So note at the bottom that salary sacrifice, that's a way of arranging for your employer to pay your contribution through the payroll, and that can also save some additional national insurance, although that's changing in a few years' time. So I mentioned the concept of adjusted net income. That's just your income that you normally would say, I earn X amount of money, but we adjust it for the amount you pay in pension contributions and the amount you pay in charitable contributions. And it's that figure which is important for those tax traps we talked about, the losing your personal allowance and the losing the child income, the child benefit. So they can reduce a 60% tax band, that nasty 100 to 125 tax band in which I told you you pay 60% tax effectively, and the child benefit tax charge from in that nasty 60 to 80,000 pound band, into which a lot of people will fall, and also the high rate tax itself. It can take you out of the 40% tax band back into the 20% tax band. So an example there again. If you have income of 70,000, but you decide to put £10,000 into a pension, your adjusted income is only 60,000 and you get your child benefit back. So that is a win for you and a loss to the Chancellor. So pensions are really, really powerful. You are limited how much you can put in, but the limits are pretty good, really. You can put in £60,000 a year, but not many people do that. Although there is a cap on that, you can only put in as much as you earn. So despite it being 60,000, if you only earn 40,000, that's as much as you can put in. If your employer contributes, they can put in more for you. They're not restricted by the earnings, but it all does count towards this £60,000 a year overall maximum. If you don't use your 60,000 in previous years, you can bring some of those allowances forward to the present year, and so you can sort of catch up for the previous 3 tax years. So that's pretty useful. People who have a large amount of money, perhaps in cash, and they've been a high earner, and think, well, how can I avoid some of these tax traps? You can do that by making pension contributions and really benefit from the tax system. So income splitting. This is the concept of not having all your eggs in one basket in the sense of husband and wife, partners. If you're in a married or a civil partnership, it's quite common for one person, the breadwinner often, to have most of the assets and most of the money in their name. Maybe it's a rental property, maybe it's just the bank accounts, things like that. Maybe it's investment funds. It's often the case that the other person is earning a lot less and they're not using all their tax bands. Well, it's not a great idea having all these assets in a higher tax-paying person's name. If you split that money between you, or those assets, or even the property between you, you can allow both partners to use your allowances, your personal allowances. Remember, that's the tax-free bit at the bottom of the calculation, the 12,570. The basic rate band, it's lovely to have your income boiling all into the basic rate band rather than into the 40% band. So that will apply to investments, investment funds, unit trusts, savings, money in the bank. A lot of people we find have all the money piled in one person's name, and it's often not a great idea. Buy-to-let property is a very common one. It's in the name of the person whose house it perhaps originally was, and they perhaps can save tax by moving it into joint names. And also, if you have a family business, splitting dividends. And this is more commonly, people are aware of this, splitting it between husband and wife, but it's still something to think about. Now, it's important to say that this isn't just a paper exercise. If you do this, assets must be genuinely moved. It's not just something you can to make a statement on a piece of paper. You must actually share those things with the partner. And at the bottom of the screen, there is a negative side. You must remember that divorce can affect this. If couples split up, then having given assets to each other can obviously have an impact there. So there's what we sometimes call a divorce tax can come in. But just as an example, if you have investment income of £20,000, well, that's great. But if it's all received by one person and they're a higher rate taxpayer, they're going to pay a lot of tax on it. £8,000 if it's rent or interest, less than that if it's dividends, but still quite a lot. So let's say that we split it between that person and the spouse, who's a basic rate taxpayer. Well, that half, it's obviously taxed a lot less. The potential tax saving there is a couple of £1,000 a year in rent or interest, or 2,500 if it's dividends. So that is a proper saving, and it's really easily done. So these sort of ideas that we talked about, the moving income, taking advantage of pension to reduce your adjusted income, all of these things can really give you more money in your pocket, which is, at the end of the day, what we want, rather than the Chancellor. Now, there's a few other things to talk about, and I'm going to pass over to Scott to talk about those. About timing of income, he's also going to talk about ISAs and capital gains tax and inheritance tax, which is a big one. So without further ado, Scott.
Cheers. Thank you very much, Martin. Timing of income. This is a thing that's probably overlooked by some people. I'll just run through some very quick examples. The first point to say is that some of the tax rates are increasing. So in simple terms, dividend tax on basic rate taxpayers and high rate taxpayers, albeit bizarrely not additional tax rate payers, is increasing by 2% from next tax year, so within a month's time. And income tax on savings and rental income is increasing from April 27, so that's a year later. So simply that's going up by 2%. So again, if you're a business owner and you're thinking about, well, do I pay myself a dividend in the new tax year or do I pay it today? There is an argument for paying it earlier. So because you'll be paying as a high rate taxpayer 33.75% instead of 35.75%. So there's 2% saving. So if that's a £10,000 dividend, that's potentially £200 for paying it now versus later. There are some caveats in this, and this is where people need to be careful, which is we mentioned earlier about all these tax traps, and that can add or take away from that plan. So on one hand, if you're thinking, well, I'll pay my dividends now, so I'll pay 33.75 instead of 35.75, so I save 2%. Well, that's great. But if you're on that 100 grand earnings, that's going to put you into a 60% tax band. That's a really bad idea. So that's going to cost you more than you'll save. So again, this is where you need to speak to your accountant and or financial advisor just to double check that. Equally, if you're actually through that 60% band, so maybe you're on 125,000 total earnings and you're taking 50,000 salary and 75,000 of dividends, you might actually be better to take more dividend this year, pay the 45%, being the additional tax rate band, but then to take less next year, so you can actually bring yourself down below the 100. So yes, you're going to pay some of the additional dividend tax rate, but you take yourself next year out the 60% band. So almost we would call it a yo-yo strategy of a high income one year to pay more tax in one sense, but to only have one 60% tax trap. So next year you pay yourself less and vice versa. So there's some things about that. On the savings accounts points, there's a issue with regards to fixed interest savings accounts, 1 year, 2 year type accounts. They generally, not always, but generally they pay the interest at the end of the maturity. So in year, 2 years, 3 years time. Again, you want to be a little bit careful on that. You want to check obviously the rates and the terms and etc. And it's not, don't let the tax tail wag the investment dog, as it were. But if you've got, say, a 3 years fixed rate savings account that's paying out in 3 years time, well, that interest is then going to fall into the tax year when you're going to be paying an extra 2%. So when you're weighing up instant access, short-term notice accounts, and longer-term notice accounts, just bear that in mind. We've done it before really cleverly where we've worked with clients to adjust their other income, dividend, pension, etc., to actually create a year when their overall income is much lower at the same time that those fixed rate accounts mature, and that can give an incredible income tax saving. And you have to be on the ball and quite clever, but that's obviously what we do here at Ready Turton. And so we're moving on to ISAs and things like that. So, okay, why tax shelters matter and do they matter? There was a period when interest rates were low, people thought ISAs weren't really worth bothering because there really wasn't much of a tax thing. What we've seen with interest rates going up, then people's taxable income has gone up. If you haven't been using ISAs, then people have been kind of caught out by that. So that's why we're always a big fan of using ISAs. So if we just look at a client with £100,000 of investment, 5% dividend income, they're a high rate taxpayer. We'll ignore the allowances for ease. There is a small dividend allowance. So essentially, outside the ISA, they're paying nearly £1,800 in tax. Within the ISA, it's tax free. Now, if this is a couple and we're talking now, well, okay, and they haven't done any ISAs, well, we could put two lots of 20,000 into ISA this year for husband and wife, that's 40. We do the same in a month's time, 6th of April, that's 80,000. And then so basically within just over a year, we've got the whole £100,000 in comfortably. So this isn't an academic exercise. It's quite easy to do if people are proactive. ISAs, just to recap, sure most of us here today will know this, but it's £20,000 per person per tax year. Couples can effectively invest £40,000 per year, i.e. £20,000 each. They include cash ISAs, stocks and shares, lifetime ISAs if you're saving for your first home and other things. Junior ISA, good idea for kids and grandkids to run that, but the limit's there to £9,000. But they really are one of the key building blocks of financial and or tax planning. Again, so why are ISAs so powerful? Hopefully we'll know this, but yeah, no income tax, no capital gains tax. You don't get tax relief in the way that you do with pension contributions, but once the money is in the ISA, effectively it's tax free. We would say tax free forever, but that is with the caveat until the government change the rules. So they haven't changed the ISA rules in that sense from day one. So we're going to assume they're going to keep it forever. No tax reporting, use it or lose it. Unused allowances can't be carried forward. So if you've got significant money, so I used that £100,000 example a moment ago, where if John and Jane don't put the 40,000 into ISAs this year, they've missed out. So it's going to take an extra year to get that money in, which is obviously not ideal. It's worth pointing out, we'll mention on inheritance tax in a moment about income exemption and gifting. ISA income, even though it's not taxable, does count for that exemption. Not everyone realises that, and I'll touch on that in a moment. So again, just the long-term value, 20,000 a year, 10 years, that's £200,000 you've paid in, plus hopefully growth and or interest, so it's probably worth more than that. £40,000 for a couple, and as I said, all future income and growth tax-free, hopefully forever, certainly unless the government change the rules. So again, well, okay, what's the cost of not doing this? Well, if you'd put £20,000 into an ISA for the last 20 years, we assume 5% growth, which isn't excessive, and then you want to cash that plan in, within the ISA, there's no tax. So no income tax, no capital gains tax, all the money's yours. Had that just been in a normal, general, what we would call a general investment account, basically a non-ISA investment, you'd be looking at capital gains tax bill of about £63,000, some bit of that region. So it's not small change. It's a huge amount of money. Again, this is the thing that you'll see in the Daily Mail a lot about couples with £1 million in their ISA, which is not common, but isn't unachievable. So again, the couple puts in £20,000 a year, 40,000 a year. We assume 5% growth. After 20 years, that's 800,000 invested, a 1.3 million portfolio. They might say, who can afford that? To be honest, a lot of our clients are earning seriously good money. They don't spend it all, and there's a very good way of putting it away. And it's not only the tax advantage kind of as you go along to some extent. If you look at that as kind of an income strategy, it doesn't replace pensions, but as an addition, at the end of that 20-year period, we've got 1.3 million in a pension. If we get a 4% yield, which to be honest, you could currently probably get with a cash account, a cash ISA, or some kind of dividend type strategy, well, it would save between 18 and 20,000 pound a year in income tax every year, depending whether it's dividend or interest. So effectively, it's almost paying you one whole person's ISA every year just in the tax saving. So this starts to seriously add up. Capital gains tax. So say pensions is ideal, ISA is ideal. So hopefully, for a lot of people, they won't have a capital gains tax problem. But if you've got more money than you can pay into those and you've got money invested, then it's going to be hopefully make a return. And if you realise that return, you have to pay capital gains tax. Those rates are 18% for basic rate taxpayers, 24% for high rate taxpayers. And the gain effectively moves you between the bands as well. So if you're basic rate taxpayer on 50,000, you make a £50,000 profit, that profit then effectively pushes that gain into higher rates of tax. So that's just important to be aware. There is an allowance, used to be much more generous, used to be 12,300, I believe. It's currently only 3,000. So this is one of the hidden tax raids that the government kind of does on you in the sense of reducing allowances over time. But it's still 3,000, which is still something. Couple, effectively 6,000, husband and wife. Again, this is an allowance that can't be carried forward. So if you don't use it, you lose it. So what we will do for clients a lot is we will do a lot of changes every year to utilise this £3,000. So if a client had, say, a £50,000 portfolio and at the end of the year it's worth 53,000, so 6% is an okay year, we might then rejig it entirely to sell it and rebuy it to realise that £3,000 profit, effectively rebasing it. I would argue that all good financial planners should do it, but in my experience, not all do. So again, so if we realise that £3,000 profit or gain each year, so effectively rebasing it, well, over 20 years, that's £60,000 of gain realised tax rate. As I said previously, the allowances were more, so it would be even better. £120,000 for a couple. Now, if we look at the couple, and we said that CGT is probably 24%, so we call it a quarter, make the maths a bit easier. That's a £30,000 capital gains tax saving if they then need or want to encash that money at the end. So again, these are, they're very big numbers. Planning strategies, better and ISA, where we take it from your non-ISA, use the CGT allowance, put it to an ISA, so supercharge the tax benefits really. Using spousal exemptions, we can transfer husband between husband and wife. Might have mentioned income splitting. It's kind of that idea. So you pass assets to your spouse and they tax it. Important, this is only for married couples and or civil partnerships. If you're in an unmarried partnership, cohabitation, etc., then a gift to your spouse is going to be disposable for capital gains tax purposes. So you have to take care on that. Also, reporting capital losses. If you do make a loss on an investment, you actually have to record it. Otherwise, that loss, you lose the benefit of that from a capital gains tax purpose. In simple terms, I've bought some investments, they haven't worked out very well. I've sold them, lost £10,000. If I do nothing because there's no tax to pay, that seems sensible. That £10,000 effectively disappears from the tax system. Whereas what I actually want to do is speak to my accountants or put it on my tax return. I've lost that money. That loss is then effectively recorded. And if I then make a £10,000 profit elsewhere in the future, I can offset it against that so I don't pay any tax. Again, it's a simple thing, but people do overlook it. Better and ISA, as I said, this is just taking money from non-ISA investments, selling some to realise a gain for capital gains tax purposes, and moving £20,000 or £40,000 for a couple into ISAs. So again, and we do this a lot. So we'll start with a big pot of money, which we can't all get in ISAs. We will slice it and dice it every year and put it into ISAs. So effectively moving from a tax environment to a tax-free environment. And in one hand, it's very simple, but it's amazing the number of people that don't do it and then have a tax problem down the road, which could have been with sensible, proactive. None of this is aggressive, and none of it is Jimmy Carr type tax planning. It's going to get you on the front page of the Sun. It's all perfectly legitimate, but not everybody does it. Inheritance tax, that's an increasing concern to people and will get worse from April 2027, when in simple terms, pension funds are going to be included in your estate. So one of the big tax planning angles we've done, pensions, which still are incredibly powerful planning tools, was use pensions for inheritance tax planning. That advantage is effectively going from April 2027. So therefore, some people who don't have an inheritance tax problem today because they've got a lot of money in pensions will suddenly find themselves having an inheritance tax problem. Other people that already have an inheritance tax problem, it will get worse because the pensions are going to be included. So this is, inheritance tax is always a key concern of clients, and this has just ratcheted it up to a whole new level. Literally overnight, I would estimate that the inheritance tax problem just created amongst our clients from this change is probably in the region of about 40 million. So this is not a small number. So people now need to be much more proactive than they were for the last 10 years. And one of the easier ones to do, it's not a massive thing, but it does help and it does add up, is that we can all gift away £3,000 from ourselves to anybody we like per tax year, and that is tax-free from inheritance tax purposes. A couple, that adds up to 6,000, and if you didn't use last year's gifting allowance, you can use that as well. So effectively, we can give as a couple £12,000. Again, that allowance only carries forward 1 year. So if I haven't given any money, I could be giving my boys £12,000 this year. If I don't, then technically I can give them £12,000 next year because I'll be using this year's allowance, but I wouldn't then be benefiting from next year's allowance in a sense. I've lost one. So you want to do it. Second thing, last time we did this, which was a year or two ago, we talked about this a lot, and I'll just cover it very briefly. There is a bizarre thing in the tax system where they seem to treat income and capital differently, which actually works really well. So in a sense, the revenue kind of says, well, actually, you've just got some income. I'll pay some income tax. It's a bit unfair to charge me inheritance tax on it as well if I give it away. And so what they say is, if I've got more money coming in, net of tax, than I need to spend for my normal, day-to-day living type thing, I can give that tax free. If I don't take advantage of that by way of kind of a regular transfer of the money coming in and it going out again, effectively it becomes capital very quickly, and I do have an inheritance tax problem. But we can use that for school fees, supports for grandchildren savings. We can pay it into pension contributions for the children, on a regular basis, provide regular support. Maybe just some of these, daughters take a career break to look after children. Maybe we just pay £500 a month into their bank account to help them out, pay the mortgage, whatever it is. As long as you can show my income is here, my expenditure is there, there's a gap, and you're gifting away some or all of that gap, you're fine. It's worth pointing out that ISAs, whilst not taxable in any way, shape, or form, apart from inheritance tax potentially, the income from ISAs can be used as part of this equation. And so it's not just your taxable income. So this is a thing people overlook. So some people might have £20,000 in ISA income. And when you add that income might be all excess, and might be able to gift it away tax free from inheritance tax perspective. So this is, again, really good planning. You have to kind of set it up and kind of get going. It's not like a big win at day one, but long term, it's massive. Very small point, small gifts allowance, £250 per person. You can't combine it with the 3,000 gifts, so you can't give your son 3,000 and 250 and it be exempt. But you could give your son 3,000 and his children, so your grandchildren, 250 each. So if you've got 10 grandchildren, that's £2,500 a year. Again, we're couple, grandma and granddad, that's then £5,000 a year. I always joke that Genghis Khan is supposedly, great grandparent or whatever it is to about 1 billion people. So theoretically, you could give about 250 billion away a year. So again, it can add up if we've got lots of children, lots of people we want to benefit. So again, this £6,000 a year, i.e. £3,000 for husband and £3,000 for wife, or husband and husband, I suppose. 10 years, that's £60,000 out of your estate, tax-free. A potential high HT saving, £24,000. So again, and by doing it on an annual basis, arguably it should be more manageable. It's not as big a commitment as making a huge gift. We do a lot of huge gifting and trust for that, but this is a smaller end, but it's also the more manageable and the more less likely to affect your overall financial position, because you can stop doing it if it becomes an issue. So quick end of year checklist. I suppose number one is probably, do I have an issue? Look at the numbers or speak to us or your accountant about, okay, what's my problem? Is it something I need to concern myself about with Scott or Martin? Pension contributions is normally number one. There's some reasons why it might be, but normally that's the go-to. Again, if we're retired and not working, that's less of an issue or less of a benefit, I suppose. ISA allowances, as I mentioned before, very, very powerful. We should be using those. Reviewing your capital gains tax CGT exposure. Again, that's a relatively easy win for portfolios. Sometimes it'd be as simple as we are selling ABC managed fund and we are buying XYZ, or XYZ if we were English, managed fund. And those funds can be very similar performance, very similar charges, but that can save us capital gains tax. And this is the kind of exercise we do on an ongoing basis. As I use the gifting allowances, check the income levels, especially income from ISAs, which is hidden, even dividend income in an investment ISA. Look at adding it to your overall income. Look at your expenditure. Look at whether there's a gap. Look at whether we want to be gifting on a regular basis. And if so, put in some kind of strategy. As I say, it could be as simple as standing orders to the children, or a gift through a trust or pension contributions, or even ISA contributions for children. So is it worth reviewing your position before April 5th? I'd say most people should review their financial affairs on a regular basis anyway. But the key people that are going to benefit, I think, is if your income is approaching 50,000, 100,000 or way in excess of those numbers. If you've got investments outside ISAs or pensions, because there's capital gains tax planning, income splitting, all the other things we've talked about. If you expect bonuses or dividends this year, now again, we're towards the end of the tax year, but I mentioned you might want to bring dividends forward, but then equally, some people might want to push them back. So again, there's a lot of planning on this, and normally best to speak to us or your accountant before making that action. Better to be kind of pre-warned if you're going to create an inadvertent tax issue. If you've got unused ISA allowances, amazing that people have still got savings and not fully utilising their ISA allowances. Sometimes on cash savings, there's a little bit of a rate difference. So there's an argument there on getting penalised for doing an ISA. The banks like to diddle you, I would say, in terms of giving a slightly lower rate. But if you're a high rate taxpayer, that still normally works out in your advantage. Again, if you hold large cash savings, again, there's an issue about whether that could be used more tax efficiently. It doesn't have to not be cash, but it can just be perhaps through even a pension in some cases, or an ISA just more tax efficiently. Again, income splitting we mentioned earlier. If you're considering helping your family financially, this then ties back into the inheritance tax planning and other ways. The other thing is, if you've got too much money yourself, now we mentioned earlier about husband and wife putting in 40,000 a year into ISAs and how that adds up. Well, maybe we could start helping the children today from their ISAs, rather than you having too much money, dying, paying a load of inheritance tax, and then being stuck with all this money, but then not be able to put it into a tax efficient shelter very quickly. We could be very proactive, which saves you potentially income tax and capital gains tax, hopefully inheritance tax as well, and also children income and capital gains tax. So it's a win-win for everybody concerned. And if I'd say if two or more of these apply, then a review is definitely worthwhile. I'd say one is probably worth a chat, but if two of them, then it's almost certainly going to be worth giving us a call. So in conclusion, me and Martin have covered the hidden tax traps. We've looked at the big tools, pensions and ISAs, and touched on some smaller points. Again, don't ignore CGT and gifting allowances, especially if we've got, again, assets outside an ISA and or inheritance tax problem. Timing matters, as I said, income splitting, dividend timing, and all those things. And you can win or lose on that depending what you do. We're very good at sitting down with you and either a calculator or even a pen and paper and work it out kind of longhand to kind of, whether you will save or lose money by doing certain timing issues. Next step really is, if you're one of those people who've got one or two or more of those issues I mentioned earlier, a short tax year end review can confirm what's worth doing in circumstances. I point out that's not on the slide, but Easter, I believe, falls really badly for the end of tax year. And that is from a practical angle of not only ourselves and our availability because of bank holidays and things, but also providers and the ability to make ISA contributions and pension contributions. So on one hand, I'm sitting here thinking, well, we've got a month, probably got about 3 weeks.
Yeah.
And my diary is filling up, and I'm sure Martin's is as well, mentally at the moment, end of tax year normal. If ringing us or any financial advisor on the 5th of April, I'm not sure if anybody's open, it's probably too late. So you want to do it early. Just final, I mentioned earlier, it's none of what we do is Jimmy Carr type shenanigans. There's a quote from Lloyd Clyde, which is often quoted, but in simple terms, that the tax man and the government use all the powers that they have, which are immense, to take every penny out of our pockets that they deem is fair and reasonable. But we're in there, there's various rules, and there's nothing to stop us and nothing immoral and nothing illegal about us using those same rules, which we do not create, in order to keep as much in our pocket as we can. And I've never had really a client who's had a moral issue on that. We would never do anything that we think was questionable anyway. Again, so how can Ready Turn help? Well, again, if you'd like help, just give us a call or drop us an email. martin@readycertain.com is probably the first call. And we can tell you what's relevant before the 5th of April, whether or not we think you've got an issue. We can also tell you whether it can be left till later, which is less of a panic and less need to rush things, and what you can ignore entirely. It should have been mentioned, I think, on the invite, but we have the book by Paul Olmsted Enough. It's a kind of financial planning guide, explains how we work. We've mentioned inheritance tax planning quite a few times. The key point is actually, do you have enough or actually too much? And if you've got more than enough you need and you've got too much, then yes, we probably should be looking at inheritance tax planning if you want to pass more money to your children and less to the government. Questions and answers. 1 second. I'll pass over to Martin for this. We're probably a team effort. Let's have a quick look. So we've got a couple of questions here. Okay. So if I earn just over £100,000, would making pension contributions help reduce the 60% tax issue?
Yeah, it would. That's one of the examples we looked at a little while ago. If you are earning £100,000 and you get a pay rise, we put you up to £105,000, and that £5,000 falls in that horrible 60% bracket, not 40, not 20, not 45, but 60%. If you make a pension contribution of at least that amount, then it takes not your income, but your net adjusted income, is a phrase, down to the threshold or below. So you basically save 60% tax on the money you put into a pension. Now, you don't have that money in your pocket anymore, and it's tied up because pensions are tied up until you retire. But it's a proper saving, and that money is yours for future use. So I'd absolutely encourage you, if you can afford to put that money into a pension, or alternatively, you make a charitable donation with that money, then that will save you that 60% tax. Absolutely.
Okay, thank you, Martin. Another question is, should I prioritise using my ISA allowances before contributing more to a pension or vice versa?
Well, this is one of those things where both things are really, really useful. But as we just explained, pension contribution can be really useful, not only in avoiding those tax traps, also actually saving the tax. I remember I said right at the beginning, you earn money and pay tax to the government, put it in a pension, you get that money back. That's basically it. So that's a great thing. And also the third thing is you're building a fund for retirement. We all want to get to our later years and be independent and have some money to do the things we want to do. So they're all really great advantages of having a pension. But on the other hand, that money is tied up. For most people until 55 or 57 or perhaps later, depending on when you're going to retire. There is something to be said for having an ISA, which is still a very tax efficient environment, to have money which is still invested, still doing well, still really tax efficient, but is accessible in times of need. So I would encourage people to have a balance between the two, and we can help you find what that balance should be.
Okay, I think last question. Okay, you understand all the points about the tax paying, Scott, but I've got some investments I actually really like. I don't actually want to sell them. Should I just keep them? Well, in simple terms, possibly not. So, in terms of capital gains tax planning, one of the catches of capital gains tax planning is generally you have to sell an asset and then you can't buy it back for 30 days. And obviously, if it's an investment you like and you're worried about not owning it for 30 days, it might go up in value during that time. That's potentially dangerous. There were a couple of ways around that. So one I mentioned earlier about Bed and ISA. So we sell £20,000 of that share or fund, and you buy it back in the ISA, and you can generally do that on the same day. There's a bit of market risk, but which should be nominal. The other way we talked before about transferring assets between husband and wife in order to utilise both allowances. There's another cheat, or it's probably a better way to describe it, is there's nothing legally to stop you selling £20,000 of Fund A or Share A, and at the same time your wife buying £20,000 of Fund A and B. Now, obviously, you've got to trust your wife if you're giving her the £20,000, and we mentioned divorce risk earlier. But in simple terms, you as a couple would own broadly the same assets in the same fund or share. Again, it might be a small bit of market risk because you might be selling at, I don't know, 12 o'clock and she might be buying at 12:01, but that should be relatively minor. But again, if we're doing that on a basis, and essentially husband and wife could do this almost forever and realising a £3,000 profit, that from a tax angle is likely to be much better than holding on to that one particular share in your name, not selling it for 5 or 10 years, then hopefully realising a profit but paying a big capital gains tax bill. So there are some clever tax planning things that people don't necessarily think of. So yeah, we're not saying people you have to get rid of an investment that you like. Obviously, normal things you review the risk and reward, etc., and make sure it is a good investment. But from a tax planning angle, there are things that we can do with even investments we like and don't want to get rid of.
Thanks, Scott.
I think that's it.
No more questions? Well, in that case, thank you very much, everyone, for tuning in today. If you've got any questions at all, would like to talk about anything, please get in touch. I'm martin@rowleyturton.com and it's scott@rowleyturton.com. Please get in touch. We'll be delighted to hear from you. We will send an email with a recording of this webinar. We've got one more. That's my last words. We've got another question coming in. An anonymous attendee says, bed and ISA deals. This is where we move money out of a non-ISA into an ISA, so it's more tax efficient. If you sell £20,000 of shares and then ISA, what is the implication if the gain is more than £3,000? Well, good question. Ordinarily, what we'd want to do is sell as much as we can of the non-ISA within that £3,000. So if you've got £10,000 holding and £3,000 of that is profit you've made, you could move all of that £10,000 into the ISA and that £3,000 profit is still within the allowance. But if that if that profit was more than that, then yeah, you'd either be limited on the amount you could sell to move into the ISA, or you'd have to accept a little tax bill. So you do have to work within that allowance, unfortunately. As Scott mentioned, that £3,000 allowance is pretty small now, unfortunately. It used to be a lot more. But we do what we can. For most portfolios, we find that doing that regularly, year after year, we can move quite a lot of money from the non-ISA into the ISA, and then great, tax-free forever and ever.
Yeah, to add to that, I think obviously we need a bigger part of the picture. So if you've got, say, £20,000 of shares, and that's all we've got, and we've got, say, £6,000 gain, and we've not got any other money, then what we'd say is, well, the ISA allowance is hopefully it's going to be there for a while, and we don't want to pay tax unnecessarily. And parking aside any issues about risk holding an asset for longer than we perhaps need to, what we might do in that situation is sell £10,000 today, as it were, £3,000 profit, put that into an ISA. Sell another £10,000 in the next tax year, another £3,000 profit, and we've used 2 ISA allowances.
And at this time of year, that's only a few weeks, so we've got a lot of cost of the tax year.
That works really well. Again, you might use the spouses. Now, if we're in a situation whereby we've got much more assets than that, so we're always going to have more than enough and always going to be funding the ISA allowances, so we don't miss out on the ISA allowances, and we're always going to have a capital gains tax problem, but the only money we can put into an ISA is from this investment portfolio, it might be practical to say, right, okay, we'll sell £20,000 worth of shares. That's going to be a £5,000 profit for sake of argument. Yes, I'm going to pay capital gains tax on that £2,000 excess profit, as it were. And if I'm a high rate taxpayer, that's going to be 24%, so £480. But the bright side is then we can fully fund the ISA. So we now got £20,000 in there. So next year, we're not getting gain on that money. So if you think about the other ways, Martin said, and I said earlier, well, we sell some of it. So we sell 14,000 only to realise the 3,000 of gain, which from a capital gains tax planning perspective is much better. We've then got 6,000 of money we didn't put into the ISA. Well, hopefully that £6,000 is going to continue to grow. So next year, our capital gains tax problem is going to get worse. So again, it's a kind of a judgment call, and we would sit around and sometimes, nobody likes paying tax. We at Ready Certain as hate to pay tax as much as you do. But sometimes it's necessary to pay some tax today in order to have a better longer term tax saving.
Yeah.
And I think that's the key point. And you've just got to be very pragmatic about it. And sometimes you just have to take the tax hit. Equally, we mentioned before, we're not really part of this exercise, but if you've got investments and all your eggs in one basket, but there's a big capital gains tax bill, sometimes the sensible thing is, well, I'll take the capital gains tax hit just to get out of having all my eggs in one basket. And the danger is you hold on to that single investment. If it continues to do well, fine, because you're worried about capital gains tax, so you keep it. But if that does a kind of, a Marconi or an Enron or a Woolworths or Wilco's or something like that, and then just disappears overnight, which companies can do, especially less of a problem in share of funds, but certainly individual shares. So you do have to be careful. So everything we said is about sensible tax planning, but you still need a financial planning and a kind of investment planning overview to make sure we're not, or you're more importantly not doing anything reckless, really, reckless from an overall wealth situation.
And we can help you with that.
Yeah.
So thank you for that last question. Again, let us know if you have any other questions. We'd love you to get in touch. Look out for another email in due course with the next of these webinars that we do periodically, normally every 2 or 3 months. And we look forward to seeing you at the next one. Thank you very much.
Cheers. Thank you, everybody.